Good afternoon, everybody. Thank you for joining us. My name is Mike Benson. I'm a managing director in the investment banking group at Stout. For the last 20 plus years, I specialized in the industrial sector with a specific focus on the plastics industry, where I spend probably 90% of my time. Myself and others in the plastics team in Stout have executed many M&A transactions in plastics, ranging from family-owned injection molders to divisions of large multinational corporations, as well as private equity-owned plastics companies. With the exception of a few years around the Great Recession, has been a great run for most in the plastic space. A time of unprecedented growth and profitability with ample opportunity for those looking to buy or sell. However, with the onset of the global COVID pandemic, that has changed for many companies. In working with companies and speaking with my contacts in the industry, it seems that the level of impact on businesses varies tremendously, and it really comes down to the end market that these companies serve. So on one end of the continuum, you would have a company that serves the automotive industry that has probably been most deeply impacted. A lot of them have literally been shut down for the last 2 months. And then on the other end of the continuum, you have some, for example, in the medical space. We've got some clients that we're working with that are actually seeing tremendous growth, depending on the type of medical device and products they're serving. But one thing that we have all learned, I think, in these highly uncertain times is that one now more than ever needs to plan for the worst and work towards the best, both in terms of business and personal life. In business, we'll talk about that, but it may come down to things like conserving cash. And on personal life, it would come down to things like making sure you have enough toilet paper and paper products in your pantry. And I know that joke is getting old. But anyways, while most in the plastics industry know Stout for advising on M&A transactions for well-performing companies, they don't realize we have significant expertise in the turnaround and special situation space. What we wanted to do today is have some of my colleagues, one of which is John Baumgartner, he is in the turnaround group, and Mike Krakovsky, who is a special situations investment banker. We'll have them walk through some concepts that should be useful for all operators of businesses in these highly uncertain times. These concepts will be, or the topics will be status of the market and the anticipated wave of restructurings. There is typically a lag that comes with restructurings, and I think we're going to see that in the next couple of months. Mike will speak about that. Strategic alternatives for leveraged companies. And lastly, some ideas on liquidity management that really all companies can and should take into play. And we hope to get some interesting questions from the viewers as well. But with that, I'll turn it over to Mike Krakovsky.
Great. Thanks, Mike. And thank you all for joining us. So Mike Krakovsky, I head up the special situations practice at Stout. I've been a special situations banker for about 20 years, most of those years at Houlihan and the past 4 at Stout. And this has really been a sea change event, the COVID-19 and related, lockdowns. It's been, frankly, quite slow in our industry on the distress side for the past 11 years. And now we're really seeing a flurry of activity. And there's really been dislocation in a wide range of industries. The immediate shock and the immediate shutdown really most dramatically impacted at the beginning retail and restaurant companies, and I'm sure all of you heard about a lot of the big retail companies that have filed for bankruptcy or liquidated. Companies like Neiman Marcus and JCPenney most recently filed. I'm sure they're going to restructure, probably downsize their footprint. But some other, more marginal companies or not as well capitalized companies like Art Van Furniture and Pier 1 are moving more towards complete liquidation. And outside of retail and restaurants in the travel sector, another broad swath of industries and niches that got severely impacted. Airlines and hotels, as everyone could imagine, have seen bookings decline precipitously. Car rental businesses as well. Recently, Hertz filed for bankruptcy. I'm sure you all saw that. Apparently, they do over 2/3 of their business at airports, so they were very heavily correlated, with travel. And more broadly in industrial sectors, companies really, when COVID first hit, they were hoarding cash, and there was really a run on banks. We saw a lot of companies fully drawing down revolvers sort of preemptively to build a war chest to kind of weather the storm with COVID-19. And it's also been reflected in terms of their CapEx spending, which has fallen off a cliff in a lot of cases. So really broad reaching implications of this desire of companies really to hoard cash and cut discretionary spending. Everything consumer related as well is being negatively impacted. Also some niches within healthcare, sort of non-essential healthcare services, things like ophthalmology and dental practices, very severely impacted. any services requiring an in-person visit, have seen business really fall off a cliff over the past few months, and maybe now finally starting to trickle back. Most of the restructurings that we've seen so far have been with larger companies. We do expect a big wave of middle market restructurings to come, probably starting at the end of Q2, maybe July and August, and certainly once Q2 results are reported, and then into Q3 and Q4. One of the issues is that a lot of these companies, by the way, are really living off PPP money, and the thought is once that runs out towards the end of Q2, there's going to be a reassessment of what companies' performance looks like. Liquidity challenges are going to be in place, and the big issue is that the financing market is not as robust and available as it was before. So a lot of these companies are not going to be able to finance their way out of their problems. We expect a lot of covenant breaches starting in Q2, really with the shutdowns happening in the middle of March. Q1 probably was insulated in terms of broad covenant violations. And really once the Q2 results start getting reported in July and August, we think there's going to be a significant influx of defaults and potentially bankruptcy filings. So far, lenders have been fairly cooperative. I know it's a general statement, but a lot of situations where they're making P&I concessions, providing covenant waivers, at least in the short term, to help companies kind of get through the very short term. And I've seen personally on some deals I'm working on very significant concessions from other creditors. I'm working on a movie theater deal right now in bankruptcy, and we've seen incredible concessions from landlords where we were able to get, in some cases, literally 100% concessions for a few months during the pendency of the case as we look for buyers to take over properties without an accrual of the deferred rent. In some cases, we had to give, 10 or 20 cents on the dollar, but very, very substantial landlord concessions that are really unprecedented. And it's the same on the vendor side, where vendors, realize that they have to, they're going to have to stretch terms and provide some flexibility for their customers. Flip to the next slide, please. So we, on the investment banking side in special situations, work in a wide range of scenarios in a wide spectrum of sort of distress. And these are the types of transactions we laid out on this page that we typically get involved with. So kind of on the far left, moving to the right, is sort of increasing in level of stress of the underlying company. So in some cases, we'll get involved where companies just have to go through difficult covenant renegotiations. They trip covenants, banks are being difficult, and there's a substantial negotiation that's required, perhaps moving amortization schedules back, moving some interest, to pay in kind as opposed to cash, and resetting covenants over the longer term to kind of get through the uncertainty over the next several quarters. Right now, I think banks have a lot of issues in their portfolio, so they are looking to be somewhat cooperative and not force everything into workout. They just don't have the bandwidth to effectuate that. But we get involved in a lot of these sort of lender negotiations. And then moving over to the right, we also do a lot of refinancings, quote unquote, special situation refinancing. So these are not kind of regular way financings where you just go out to your local bank group, take out an existing lender. These are going to alternative lenders who have a risk appetite that's appropriate for the situation, that can lend sometimes for companies that are not generating any cash flow, and they'll lend on an asset basis, and they'll be creative in structuring and do things like pick interest for a period of time while the company goes through a transitional period, or take some warrants, as a kicker to compensate them for the risk that they're taking on. So we are in regular dialogue, at Stout in the special situations group with literally, hundreds of these types of lenders. They're private credit funds, hedge funds, looking for these types of opportunities, particularly in the middle market. Another option, sort of in the toolkit for stressed companies, would be to sell assets and effectuate a deleveraging through a sale of assets. And this could happen if you think about a business that has a component of the business or a subsidiary that's not really generating meaningful cash flows, and you can sell that at some value and use that value to pay down bank debt. That has a deleveraging impact, since you're not really losing much in EBITDA in connection with the sale, but obviously you're paying down your debt by a fair amount. So that's often one of the options that we think about in different scenarios. Moving over to the right, we get into sponsor capital infusions and sort of deleveraging transactions. So we're getting into a place here where the equity is being asked to inject capital to effectuate a solution. And what we see a lot of times is sponsors will sort of teardrop dollars to fix a problem, to fix a temporary solution. And the lenders keep going back to the well, and the sponsor keeps ponying up. And effectively, they're putting good money after bad. And so we get involved in structuring more comprehensive solutions where there's kind of in one full swoop, equity may come in, but there's sort of a permanent solution to the capital structure that involves a deleveraging and long-term covenant relief. And then moving to the far right is where we get involved and just do a comprehensive sale typically through a 363 sale process in bankruptcy. And this is usually where there's not enough value to clear the bank debt. So typically equity is out of the money in these scenarios. We get into this situation, there's really a number of circumstances. Sometimes businesses just become not viable, and there could be some kind of secular changes. Raw material prices might increase, input costs might increase to a point that the company is no longer viable. In other cases, it's where companies frankly wait too long and they run out of options, and the banks force them through a distressed sale process. But we're very adept at kind of running these distressed processes through bankruptcy. So this is sort of a summary of some of the tools that we have at our disposal to deal with different levels of distress based on the facts and circumstances, of company's particular situation. With that, I'm going to turn it over to John Baumgartner.
Thank you, Mike. Thank you, everyone, for having me this morning. It's great to speak with you all. Just a quick introduction. I'm John Baumgartner. I'm a managing director in our disputes practice. I lead the turnaround and restructuring group, and I'm resident in our Houston office. So with that, I think let me just talk quickly and briefly about some of the important issues of dealing with liquidity challenges and managing through the current market. The place to start is really to understand your key stakeholders and their objectives. What are your customers' needs right now? What are your suppliers' needs, your lenders and your equity investors as well? What are their concerns? Because each of those concerns are going to be different, and they're going to help inform the analysis and the solutions that you develop as you work through these the current market. The next place to start is with a deep, fresh-eyed look at your business, comprehensive diligence of your current operations and a fresh forecast of what you can reasonably expect will occur over the next 6 months and into 2021 and 2022. And this would take two primary forms, I think. The first one would be a traditional budget update, right? A traditional pro forma cash forecast. What do you expect sales to be? What are your costs? And so forth. And that's going to help inform your ability to meet certain covenants and pay your interest as it comes due. And it's going to lead to the next slide, which we'll get to in a minute, where we talk about lender relationships. The other key analysis point is developing a 13-week cash forecast. And this is a very standard tool for managing liquidity. And using the 13-week forecast, you'll go through and you'll specifically identify when you expect to collect from your customers. You'll specifically identify when you expect you'll have to pay your vendors, as well as recognize the cyclicality of a biweekly payroll or twice monthly payroll and the normal G&A expenses. And the benefit of this granular analysis on a week-to-week basis is that you'll understand once the work is done when or if you're going to have a problem meeting payroll and meeting your suppliers' requirements for payment and meeting your interest payments and your principal payments. And this forecast, though, ideally will provide enough of a warning so that you have an opportunity to develop a solution and can plan for, okay, I see that 8 weeks from now, we're going to get really tight on cash. What do we need to do? Because the key issue here right now in a market like this is maintain your cash, right? Cash is king. Hold on to it as long as you can. Accelerate collections if possible. And the 13-week forecast will let you see exactly what you need to do. The next step in here is once you understand your cash forecast and your needs, are there ways to potentially adjust your capital structure? And this is something that Mike touched on briefly. Is let's think about what is the capital need? right? Is it a working capital need? Is it a longer term capital? Are you completing a project, finishing some sort of a CapEx and expansion, that sort of thing? Understand what your needs are, and then try to marry those needs with an appropriate source. So if it's working capital is your issue, let's think about a traditional line of credit from your bank, and let's make sure that the line of credit is appropriate. And like Mike said, to the extent possible, draw down early to maintain your cash. While you're doing this, it's important to understand that there's a range of outcomes, right? And there's a range of things that could happen in the market. So as you project forward what's going to happen for the next 6 months or 18 months, I think it's important to do sensitivity analysis. So there will be a base forecast as well as okay, what happens if things recover more quickly than we expect? Because that's obviously going to accelerate your capital needs, and you need to be prepared for that. And similarly, what happens if this downturn is extended longer than we expect? What happens then? What happens in not week 13, but perhaps in week 26? And let's make sure that management has thought through these forecasts and has developed an appropriate response. And then once you've developed that response, the key is to implement it. Develop a very detailed, granular plan of action. What needs to be done today? What needs to be done tomorrow? What needs to be done next week? And what needs to be done the week after that? And once you've implemented that, or once you've developed that plan, stick with it. Commit to the plan and move forward. And one of the first things that you're going to do once you implement the plan, and if we could flip to the next slide, one of the first things you're going to do is you're going to talk to your lender and your investors. You're going to talk to your capital providers. And as you get ready for these discussions, it's important that you just review your loan documents, right? Understand exactly what you've committed to do. Understand the covenants and the disclosures that you've agreed to provide, because the lender is going to be aware of these. And the lender is certainly going to be trying to understand, okay, how does the current market affect the company's ability to comply with what it's agreed to in these loan documents? Another consideration is just refresh your memory about how your business has changed since the loan was funded. I mean, if the loan is 3 years old at this point, there's been a tremendous amount of growth, in the 2.5 years up until 2020, right? And so there's good news, right? There should be good news to share with the bank. But think about how the loan that was originally funded, may not be entirely on point for now, and you'll need to just have some perspective with the lender about, okay, here's what's happened over the last few years. And then I think that when you sit down with the lender, similarly with your investors, present your liquidity analysis. So here's what our forecast shows. And you can go as detailed as you want in the discussion with your lenders. You can take them week by week, or simply just present sort of the punchlines. And what you'll show in this liquidity forecast is you'll see, is the issue that you've got working capital needs that need to be met? Is it growth capital or some sort of CapEx that you've already committed to that you need to figure out a way to stretch out? Or is it a loan maturity? If your bank facility is coming due this month, that's an important issue, and you need to understand, that's going to be what your lender's focused on. And when you sit down with your lender, present a view of the market, right? Your customers, your suppliers better than the lender does. Share what you understand your customers' concerns are, what the hot button issues are, because that provides context for the lender as they understand the circumstances that your business is in as you go through, as you're operating things in today's market. Describe what you've done this year, right? Things are very different than they were in January of 2020, right? What happened? How did you guys responded so far? And how do things look today? And then describe the path forward. What are you going to do for the next 6 months? How do you get to December 31st? And then when it comes time for the request, whatever it is, if it's an expansion of a working capital facility, if it's a request to roll over a maturity, if it's a request to defer, interest payments or principal payments, explain why this ask is going to benefit the lender, right? It's going to preserve value at the company. It's going to ensure that the company stays in operations for a period of time that will lead to an eventual recovery. And this is the part of, I think this is an important part of the presentation to your lender, is the ask is not just one-sided, right? There's a benefit to the lender for potential forgiveness or adjustments to a loan, and similarly with an investor. There's a benefit to the lender because you end up as a stronger company and you de-risk the situation. Similarly, there's a benefit to the company because you now potentially have access to the capital you need, or you have access to the breathing room you need to let the company recover and the market to go back to a long-term normal. And so these are just a few of I think, the critical points and considerations that should inform your analysis as you develop a way to respond to the challenges in 2020. And with that, I think we're ready for question and answer. And I look forward to hearing what y'all would like to know more about.
Well, wonderful. Thanks so much, John. Hi, everybody. I'm Brennan Lafferty, publisher of Plastics News. As John said, let's answer some of your questions. To submit a question, it's very simple. Email pnevents@crane.com. Or if you're watching the live stream on Facebook Live, LinkedIn Live, or YouTube, send your questions through those social media platforms. All right, guys, we do have some questions coming in already. First one is, are the debt financing markets open for middle market companies these days? What do you think?
Yeah, Brennan, I can take that. So I think the answer is they're starting to open up. Originally, when the shutdown first happened in kind of mid to late March, we were inundated, at Stout with emails from private capital sources saying, hey, we're open for business, ready to do deals. We have a very flexible mandate. We can invest up and down the cap structure and invest, through the shutdown. I think the reality was the bar was raised substantially to getting deals done. On the cash flow side in particular, it's been very difficult, I think, to get deals done because of lack of clarity on what cash flows are going to look like on the other side of this once everything really opens up. No one knows what business is going to be, what the new normal is going to be from a cash flow perspective. So definitely cash flow deals, much more difficult to get done, much pricier, and the bar in terms of quality has been raised. A little easier on the asset side. Early on in the shutdown, it was more problematic for the lenders because they couldn't really touch the asset. They couldn't go do appraisals. So that was creating issues. They had to do virtual appraisals. I think now it's starting to open up a bit more from an asset perspective, although I think the borrowing-based calculations have been adjusted a bit and you're not getting as much credit on things like AR, obviously due to the credit worthiness or questions around it with respect to borrowers, customers, but it is available. So I think, again, it's a flight to quality and it's an increase in pricing, and there's even a stronger bias, I think, right now towards asset-based deals.
Very good. Makes a lot of sense. Yeah, it's a little difficult to evaluate some properties if you're not actually on site like you're used to doing, yeah?
Yep, exactly.
For sure. So another question that has come in, what are some liquidity measures that management can implement in these times?
Sure, I'm happy to address that. There's a couple of things you can do on the collection side, right? I mean, the traditional offer at discount, that is certainly something that's worth revisiting with your customers. One of the things that you can do on there is take partial payments, agree to payment terms, right? Better to get something today than nothing, right? Because that's one of the issues. You need to get the cash in the door. On the cash preservation side, work with your suppliers. Work out payment terms. If you can extend payment terms, give your suppliers comfort that the relief is going to increase the certainty that they will get paid, and I think you'll be pleased with the results. The suppliers are in the same position you're in, right? They want to de-risk their collections from their customers. It's also good to take a hard look at inventory. To the extent you've got slow-moving inventory or you've got specialized inventory that maybe has been held in anticipation of, some sort of a specific customer coming back to you, think about the risk of holding on to that inventory while the rest of the company runs out of cash. It may make sense to consider selling down some of the slower-moving portions of your inventory, turn it into cash that you can use to live until the recovery, rather than hoping for sale down the road. And similar to what Mike Krakovsky shared, talk to your lenders. You may be able to get rent holidays. Talk to your leasing companies. You may be able to defer and extend the terms of a lease, where if you agree to extend the lease from 24 months to 26, they'll give you a 2-month holiday. Something like that. There's a number of different ways that you end up having to go very granular, and sometimes it's worth digging into, almost evaluate the specific ask of each of these parties.
That's an interesting point about selling off some of your inventory, because as you guys have said, cash is king, and hoping for that big sale down the line may not be the strategy to implement at this point. Yeah,
absolutely. So
here's a question that's come in. You hear a lot about this philosophy in business circles now, like taking advantage of a crisis. Never let a good crisis go by without taking advantage of it. Are there opportunities for highly leveraged companies to go on the offensive and take care of the current situation?
Yeah, let me try to take a stab at that. I actually do think, certainly for companies with cash who can write a check, there may be some really interesting opportunities. And we're seeing this now in different situations out there in the marketplace. There may be an opportunity, instead of just teardropping equity checks and putting Band-Aids and kind of kicking the can down the road and getting waivers and hoping that operations improve and companies kind of grow into the cap structure. And I kind of referenced this in kind of the range of alternatives. There is the possibility of doing what's called a new money plan, where basically an existing equity owner buys back their business, usually through a bankruptcy process, by injecting additional capital. That transaction, as you can imagine, is subject to a lot of scrutiny by the other constituents, in the company's capital structure and its vendors. So it needs to be conducted in the context of a broader marketing process to sort of prove out that the plan or the repurchase, if you will, by the existing equity is the best deal in the marketplace. And there's kind of a perfect storm now for getting that kind of deal done. For one, any business really having significant issues, it's likely their competitors. So a lot of the logical strategic buyers are probably similarly suffering and dealing with their own internal issues and not really looking to be acquisitive right now. You also have an environment where, as I mentioned before, on the capital market side, certainly with respect to acquisition financing, it's not as readily available as it was 4 months ago. So the ability of financial buyers to leverage transactions and write a big check is more limited. So certainly a lot of financial buyers can just write an all equity check and try to finance down the road, but they're somewhat hampered in terms of their ability to raise equity, acquisition financing. And then you also have businesses that are declining in EBITDA. So it's kind of this perfect storm of events for companies to write a check and repurchase their business. And I'll give you an example of something in the marketplace now of how this gets effectuated. So the company Gold's Gym, who I'm sure everyone on the call has heard of, filed for bankruptcy, and they have $50 million in bank debt. And as part of the bankruptcy, they really want to rationalize the footprint of the gyms and reject a bunch of leases and downsize the number of gyms they have in their portfolio. But in connection with rejecting leases, they generate substantial unsecured claims that outside of a bankruptcy context would have to be paid dollar for dollar. The aggregate of the claims is somewhere in the tens of millions of dollars, maybe $30 to $50 million of claims are being generated. What the owner's doing in this situation is they're writing a $20 million check that's coming in as a junior dip behind the bank debt to fund the bankruptcy. And they're putting a bid in to repurchase the deal, getting the senior debt to roll their $50 million and converting their $20 million dip financing into equity. So in other words, they're basically repurchasing or seeking to repurchase the business for $70 million. The investment banker in the deal is going to have to do a market test and confirm that 70 million is in fact the best deal out there. And assuming they can't beat the 70 million, and all these dynamics suggest that it would be difficult to beat the 70 million because you got obviously a troubled sector, the other strategics are going to be similarly impacted, and lack of financing availability. If they are successful, they're going to reacquire the business without any of those claims. So they're going to basically be able to strip away tens of billions of dollars of claims in effectuating this transaction. So huge potential savings facilitated by their ability to write a check and by going through a bankruptcy. A lot of companies are reluctant, and private equity sponsors are reluctant to go through bankruptcy because of the stigma associated with it. In this environment, so many companies in so many sectors are filing that any stigma associated with the filing is certainly very much muted right now. And even for companies that don't want to actually go through a bankruptcy, the threat of doing something like a new money plan, which really squeezes out the unsecured creditors and the trade vendors, provides the leverage to perhaps get concessions from unsecured creditors, landlords, vendors outside of bankruptcy, and usually having advisors who are credible and experienced in those types of transactions provides the leverage and credibility to effectuate those concessions. So the answer is I do think there is tremendous opportunity, and it all comes down to being able to write a check by the equity sponsor.
That's interesting. Yeah, even the threat of the bankruptcy may help you get some better terms. That's a great point. Tons of questions. Thank you so much to our viewers for sending these in. Coming in through LinkedIn and email right now. Here's the question. Many business owners haven't had problems, to Mike Benson's point at the beginning, with their businesses ever. Now they're hesitant to go ask the bank or tell the bank that they're having some issues. This is pointedly to John Baumgartner, if he's up for it. What business owners, what can business owners do to have a backup plan in case the ask of the bank isn't accepted or worse, rejected? Any thoughts on that, John?
Absolutely. I mean, this can be one of the most difficult dynamics in a circumstance like this. I think it's important to bear in mind that your bank is reading the newspapers, right? Your bank is paying attention to these. They understand that there's all kinds of challenges in the market, and so they're not going to be surprised if you were to come to them and say, "Okay, my business is struggling right now." But what is important here is being able to effectively articulate why your business is struggling. Was it a particular customer, right? Was it a broader downturn? Have suppliers, have there been challenges on the supply side where you're having trouble getting the materials you need, or whatever is the issue? Supply chain issues definitely is a concern at this point. To be able to articulate what the issue is, how you've responded, and how you're going to continue to respond, because what that does is that gives the lender confidence in the management team, right, and in your approach to managing through this challenge. And at the end of the day, it's easy for a bank to say, no, I'm not going to give you more money. But part of the presentation or part of the discussion with them is explaining, can also include explaining what will happen, because your alternatives, you can describe the full range of alternatives. On the one hand, potentially we get some additional capital. On the other hand, we get no capital. And it's in here, here's what happens, right? Now we don't meet. Now our vendors are not getting paid. Now our vendors are cutting us off. Now we're not collecting from our cut. Now we're not collecting, and now we're not able. Well, and it can be a very dire circumstance. And what you want, the banks know this, right? The banks know that if you're not collecting from your customers, you at some point will run out of money. Give them as much notice as possible. The classic, the classic problem is, calling the lender on Wednesday saying, "Hey, I've got to fund, payroll tomorrow, so my team can get their checks on Friday." That's a really tough phone call to make. It's a much easier phone call to say, "Look, lender, here's where we are. We see that in about 5 to 6 weeks, cash is going to be very tight. If you have these discussions early enough, you have a chance to have a second round and to respond to a negative response from the lender. And the other thing too is just, again, as you review your loan documents, know what your rights are, right? Know what you can do. And, like Mike said earlier, Mike Krakovsky said earlier, think about taking a very early draw entirely against your working capital facility. Even if you don't need the money, better to have it now and have the bank be in a position to ask for it back than for you to go in later and say, well, my receivables have aged, my inventory's down a little bit, and I need an overfinance. And also the other thing, and the other thing you can do is bring in an advisor, bring your attorney, bring your financial advisor to that meeting, right? Because that helps lend some outside validation to what you as the business owner are presenting has been vetted, right? Not throwing ideas out there.
So here's a question about end markets. Plastics are in practically every end market, whether it's automotive, packaging, electronics, home goods, the list goes on and on. Can the Stout team comment on where in the end market world they are seeing some of the most refinancings or restructurings? Is there a particular end market that's really jumping out at you guys right now?
Well, I can kick it off, and then Mike, you can chime in, Mike and John. But I would say that the obvious one is automotive. But I think given the amount of downturn now and the fact that a lot of these companies have been shut down, so they've been able to conserve cash. But the issue is going to be when they open up, they are going to burn through cash pretty quickly. So there's going to be a pretty significant lag effect in the automotive industry. So I think, that's where you're going to see most of it. And then any other industry that has been heavily hit, I think consumer products, depending on where they're going into, and then obviously building products, there's going to be a lag. You think about the whole supply chain and the fact that a lot of things have stopped, which means that they've been able to hold on to everything. They've been able to shut down their companies and conserve cash, but it's when you turn the lights back on and that supply chain starts back up, and then you've got your receivables came in, and now you're going to have lower receivable base going forward. I think that's going to be the challenge.
So I think that's all the time we have for questions at the moment. So gentlemen, any final thoughts or words of advice for our viewers today?
I'll start off here. I would just say it's something that John had referenced before. I think a really important thing is to get in front of problems with the capital structure and problems with the lenders. It's really imperative to, be proactive with them. Banks hate surprises. We at Stout will often get involved and sign NDAs before we have a formal engagement and give companies kind of free advice, frankly. We'll look at the situation and give our thoughts about what's available from a financing perspective. Should the equity owner think about injecting capital? How should they structure it? So we'll give a lot of that advice, frankly, for free on the front end, obviously trying to get an engagement, but definitely important to, once you see problems coming, to get ahead of it. So you're not on that far right end of the spectrum of transactional alternatives and are in a scenario where the banks are your only source of liquidity and forcing you to do a quick sale.
Yeah, I would just add that banks want to see that you're proactive. The last thing they want to see is that you're not taking action. And I think everybody has hit on it, but be proactive in communicating with your bank. They hate surprises. Your lenders, they have a living to make too. And if you make them look bad by surprising them, you're gonna lose somebody that could be looking out for you. But I think just communicate and get out in front of it and take action.
John will give you the final word.
The only thing I would offer there is hope is not a plan, right? You can't just hope for the best. You have to prepare for the worst. And like my colleagues have said, start the planning now. Get ahead of this. Thank you for the time, everybody. It's been great to share our ideas with you all.
Well, thank you, guys, for your insights today. To our viewers, if you would like to reach out to Mike, John, or Mike directly, you can email them at the addresses on the screen there. I know they would be happy to engage with you. My thanks to John Baumgartner, Mike Benson, Mike Krakovsky at Stout. My thanks to you for joining us today for Ask the Expert. We hope you enjoyed our 3 installments for our financial series. And I invite you to join us the week of June 15th for our marketing series. We'll have marketing experts sharing the importance of branding, strengthening your public relations, and improving your effectiveness in an online world. Until then, have a great day. I'm Brendan Lafferty. Thanks for watching Ask the Expert with Plastics News.